my portfolio. Pimp my portfolio.
Okay, well, it is that time of the episode where we bring in an expert, we bring in a community member to get their portfolio pimped, and it is our pleasure to welcome Luke Laretive from Seneca to the studio. Luke, how are you?
Right. Alec, how are you, mate?
Luke, very excited for this.
And our community member today is Michael. Michael, how are you?
Very well, thank you, boys, for having me.
We are looking forward to this one. Thank you for submitting. I know it's not easy getting up in front of Luke, but I think this is going to be a good one.
Dorsey seems to be much nicer than me.
Yeah, you're building a bit of a reputation, Luke. But anyway, so as always, Ren, let's kick off with what's in Michael's portfolio.
Yeah, so Michael's portfolio is really anchored by some big ETF positions. Vanguard International shares just shy of half of the portfolio, and Vanguard Aussie shares just shy of a third of the portfolio. The next two largest positions are also ETFs, Vanguard International Small Cap and Vanguard Emerging Markets. Together, they're about 17% of the portfolio. Then the remainder is 5 individual stocks: BHP, QBE, South 32, Woodside, and Worley. So with that summary, Luke, where do you want to start with this one?
I think I'll just go and then Michael can chip in.
Okay, well, firstly, let's start with the name, and then perhaps we get Michael to let us know how he got to this point with the portfolio.
Cool. I think I know the answer to this, but I'm gonna call it pissing in the wind.
Luke, this is why people say Doors is nicer than you.
No, not because there's anything wrong with it. More so just that, 1% in BHP, 1% in QBE, less than 1% in 3 other stocks is pissing in the wind. Because actually the core of the portfolio, the sort of 50% international, 50% Aussie type sort of vibe, I am totally down with. That's cool. Like, really good job, good idea. Obviously, being me, I'm going to be a proponent for active management.
All right, well, we'll get to that. Michael, before Luke goes too far down that rabbit hole, tell us a bit about the thinking behind the portfolio and how it came to be this way.
Yeah, so it starts with the single stocks, and those small positions can be explained. I bought these about 15 years ago when I was a student and didn't have too much to my name.
Yep.
I didn't really know what I was doing. I was getting some high dividend paying stocks and some pretty blue chip ones, trying to disperse them across some sectors. I really just kept them in the back pocket and not really thought much about them at all.
I thought that
I actually intend to. I actually intend to sell them in July, just to consolidate them into the ETFs. That brings us to the ETF positions. I was cash heavy after buying my home and offsetting a few years ago, and decided I needed to get started investing. So I looked at basically an evidence-based approach and decided that I wanted a broad market index approach, and I've chosen relatively low MER indexes, ETFs using Vanguard, and then tried to do that via market cap as broadly as possible. So I've gone obviously there with Aussie, international, emerging, and small cap.
Mm-hmm. Nice.
Pretty solid.
Yeah.
Pretty solid. Luke's a bit lost for words here, I think.
I'm never lost for
That's
words
true.
for us. So let's go into adding some value for you rather than just telling you how good you are.
But we should be clear that this is a great foundation.
Really good start, right? And I love, I love international shares over Australian shares as a general comment. If you're going to buy an ETF and you had to pick one thing to do, you can just buy the international shares and ignore Australia altogether. There's no reason you have to buy an Australian shares ETF for all the punters out there. So, because there are Australian shares in the international index. So, that's just by the by. Let's focus on the international small cap and the international emerging markets, and just touch on what you've done with the direct shares a little bit. So you don't need to buy, if people want exposure to resources, which is kind of where you've gone here, Michael, as a general comment, ex sort of QBE, you don't have to buy direct shares to have exposure to that. So a lot of people would have BHP or Rio or Woodside or whatever in their portfolio. You can use an ETF to do that, and that's like there's one called PIC, which is like the Global Metals and Mining ETF from iShares, and there's also one also from iShares I pulled up, which is IXC, the Global Energy ETF. So like a combo of those would sort of get you a broad-based energy and resources exposure. Obviously, I would prefer you picked an active manager. There's some good ones out there. There's the Argonaut Natural Resources Fund, the Perennial Strategic Natural Resources Fund. Their microcap's pretty good too, which are worth a look if you're interested. So that's sort of the resources side. From an Aussie small cap perspective, you don't have much exposure. So you've only got international shares, and we'll do that in a sec. But obviously, I'm going to promote the Seneca Australian Companies Fund.
Can I just jump in here because so Michael's got exposure to a index product for small caps. A couple of weeks ago, you answered a question in our email around is if you want small cap exposure, is the index approach the best way, or is it better to look for active management?
It's definitely better to look for active management.
So I think that's probably a good point to.
If you want to talk about like empirical evidence is like, pretty important when you're doing investing, and I think Michael's touched on it in his approach already. But in smalls, and I can talk to Australian smalls in particular, the evidence says that you should use an active manager and you shouldn't buy the index. Now that's because of how the index is sort of developed, or how the stocks that go into the index are chosen. It's probably a long answer to go into on a Pimp My Portfolio episode, but I'd happy to do index construction and how the indexes work another day with you guys.
I'll give you a very simple, probably not as sophisticated answer. Small cap index has stocks that are small and growing, but they grow out of the index, and then it has stocks that were larger and shrinking, and like
disrupted.
Yeah,
essentially.
and you get stocks that are kind of done or shrinking that then are the biggest parts of the index.
Correct. And further to that, on the bottom end, you get a lot of unprofitable, pre-revenue, hyped up, I'm going to throw Brain Chip under the bus, but pick another stock, type stocks that come in. Yeah, they're not massive weights, but they're still detracting from returns.
Yeah. So that's why having someone filter through the universe and try and find the gems there makes sense. Similar argument when it comes to emerging markets. A lot of emerging markets indexes are quite old financials and resource heavy. You don't get that like up and coming consumer growth story that people want from emerging markets.
I think also on emerging markets, it's a part of the world, you're investing in parts of the world where accounting standards aren't the same as they are in Australia or the US. Legal frameworks and regulatory frameworks aren't the same as what they are in markets that you're familiar with where you've been investing. And it does take a nuanced understanding of the cultural, geopolitical environment in those regions to be able to effectively analyze a company and then effectively weight that company in a portfolio. So I think that emerging markets, Aussie smalls, and probably to a lesser extent international smalls are great places to employ active managers.
Michael, had you said at the top you've obviously chosen the Vanguards for their low management ratio, which is certainly fair, but had you considered active for those parts of the portfolio that Luke's talking about?
I think at the time I bought them, I didn't have that information that you've just shared, but I have learned subsequently that active management can be either similar or more effective for emerging markets and small caps. I didn't have any hard data about exactly how they line up, and I was happy to punt instead on the low MER of an index approach.
Fair call.
when making a decision.
Yes.
Yeah, I think that it's hard to pay for something that you don't know, or you don't know what to do, so you just go like the cheapest one. Is kind of always seems to be a pretty logical approach. It's not necessarily the best approach, and I think Michael, it would be worth investigating, I suppose, or having a chat to me or somebody else about that, because definitely in Aussie smalls there's lots of good managers, there's lots of pretty average managers, to be fair, and certainly there's plenty of alpha there for people to go and chase. International smalls, I think it's a harder market. You can concentrate your portfolio in such a way that you can benefit from a lot of the value in smalls around the world without owning everything. So a lot of managers do well in that sector. I know you guys love Nick from Fairlight, but he's a mate, so I'm a big fan of what he does as well. But if you didn't want to use an active and pay Nick, you could pay Van Eck instead. Their MER is not cheap, but they've got a quality international smalls ETF.
Oh, there you go.
It's a good product.
Do you have any final questions for Luke there, Michael?
I guess on just that topic of emerging and small cap, does time frame change how you would make a decision regarding index versus active? If my intention is to keep these indefinitely, perhaps forever, does the index approach, is that more likely to be a more safe, long-term, good quality performing approach? And does an active approach, is that prone to perhaps less consistency of performance over a longer period of time?
No. You can categorically say no. It depends on your skill. It's like two people hitting a tennis ball. If I'm hitting a tennis ball and Roger Federer is hitting a tennis ball, what's the chances of it going in? Well, it depends on how good you are at tennis. So it's the same sort of thing here. You're picking a manager or you're not picking a manager. The result is the same. One requires no skill and you're not paying a lot of fees. The other one, you could choose a bad manager and make the wrong decision. So I understand why you sort of go the fence sitting, for lack of a better word, option. But certainly they're no safer or less safe. And in my view, there's opportunity for active managers to not only outperform, which everyone sort of bangs on about, generate the best possible returns, but generate the best possible risk-adjusted returns. So, for the risks they take, do they get asymmetrically paid, and taking a more nuanced approach to selecting and combining managers. So that's kind of what we do at Seneca. That's what we're kind of good at. And yeah, it's definitely doable. And it's definitely lower risk if you do it properly than just owning everything.
I think the point is, though, unlike an index where you can leave it in the bottom drawer, you still have to pay attention to if you select an active manager, you still have to pay attention to how they perform year on year on year. You
can set up a passive strategy, and like you said, once you've got your asset allocation set, the only job is really just rebalancing. I think if at all, if you choose a multi-asset, you don't even need to do that. If you're running active managers or direct shares, then obviously you're taking a much deeper interest in what you're doing. And if you're not paying somebody to do that for you, that can be a lot of work. And I'd argue too much work for someone who works full time and has other interests in life. Hence why I have a job. But, each their own.
Nice. Well, a few things there for you to think about, Michael. Definitely on the active management side, and something that we speak about on the show is how we get exposure to small caps particularly, and that toss up between international and how to choose a manager. But Luke has done a lot of research on choosing fund managers and has a pretty extensive database. So if you do want more info, we can connect you with Luke for sure. But thank you so much for coming on today. We do really appreciate you submitting. And I hope you got something out of the convo.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.